Well, thanks very much, first of all, to Shelter for inviting me to speak today. As Graham says, I'm here to talk about regulatory change, both in terms of responsible lending and arrears handling, which all forms part of the FSA's ongoing mortgage market review work. I should begin by sort of mentioning last night's announcement, and I think it's fair to say I probably know as much about it as most of the people in this room if you've read a Metro or something today. But what I can tell you is that the FSA remain committed to the mortgage market review work, as well as most of our other retail initiatives, and that will continue. So what I'm talking about today is still relevant and will be continued with over the next couple of years. Just to sort of go back to the starting point for the mortgage market review, in October last year we published the mortgage market review discussion paper, and in this paper we acknowledged that while the mortgage market worked well for many people, for a significant minority it hadn't worked, and for those consumers it had caused considerable financial distress. We also recognised that our regulation wasn't effective at preventing excessively high risk borrowing and lending. The proposed reforms set out in the MMR discussion paper complement our continuing programme to strengthen the overall regulatory regime and represent a significant shift of approach in some areas. For example, we're looking at greater intervention where we perceive that business models and strategies are creating undue risk in the market. We're also considering, for the first time, regulating and banning specific product charges. Our proposals are also based on a greater realism about how consumers behave, including the limitations on the reliance we can place on disclosure requirements as a means of motivating consumers to act in their own best interests. So following the discussion paper, our next steps have been to analyse the responses and to consult in greater detail on the various aspects where we consider change is needed. Two areas we've moved quickly to consult on already are handling arrears and approved persons, because we think these are areas where change is needed most quickly. You may well be aware of our ongoing focus on arrears handling over the last 2 years, which has covered a representative cross-section of the market. The findings of the review are clear. Consumers have not always been treated fairly when they fall into arrears. The problems we have seen have included operating a one-size-fits-all approach, focused entirely on recovering the arrears without reference to the borrower's individual circumstances, applying arrears-related charges unfairly, and being too quick to go to court action rather than treating that as a last resort. Some of the outcomes we've seen have been so poor that we have to date referred 8 firms to enforcement, and we have fined GMAC and the Kensington Mortgage Company a total of 12.8 million, of which 7.7 million must be paid back to consumers who have not been treated fairly. Investigations into the other firms referred are ongoing, and further announcements can be expected later this year. We expect all lenders to have learnt the lessons from the enforcement fines, and the actions taken show our determination to make sure that vulnerable consumers are treated fairly. We've taken this further with our first consultation paper on the mortgage market review, which focuses on arrears and was published in January of this year. The aim of the consultation paper is both to strengthen the existing requirements and to propose some new additional measures. So we have, for example, clarified our existing requirements that firms must not add early repayment charges on arrears charges and interest levied on those charges. Firms must not apply a monthly arrears charge where the firm and the customer have agreed an arrangement to repay the arrears. Firms need to consider appropriate forbearance options and any government schemes that they choose to participate in, reinforcing our message that repossession should be the last resort. And firms must allocate payments received from customers to clearing missed monthly payments first, leaving charges to be paid at a later date. We've also added a new requirement which obliges firms to record all arrears handling telephone calls and to keep all records for 3 years. And that will obviously help us in our monitoring of how they are actually treating their customers. Responses to the consultation paper have in the main been positive. There's general support for the need for borrowers in arrears to be treated fairly, but concern about the costs involved and the practicalities of making some of the changes proposed. We will be issuing a policy statement on the 25th of June, which will set out our final proposals on arrears, on both arrears and approved persons. So just moving quickly on to approved persons, this also formed part of the January consultation paper, as I've mentioned. We have proposed to extend the approved persons regime to all individuals in the front line of providing advice or arranging mortgages across all distribution channels. We believe that the extension of this regime will bring a number of benefits. It will increase the transparency for consumers who currently have no assurance about the honesty and integrity of the individuals with whom they are dealing. It will help to drive up standards in the industry as a whole, and we hope it will help to reduce the levels of mortgage fraud. The next priority for us is responsible lending, and this will be the subject of our next consultation paper in July. In this, we will set out our proposals for income verification, affordability assessments, interest-only mortgages, toxic products, and the future regulation of non-bank lenders. We will also publish the outcome of our review of mortgage arrears charges. Although I can't reveal what the proposals will be, I can remind you of what we are aiming to achieve and what firms told us in response to the discussion paper. Our aims are quite clear. We are looking to promote responsible lending and to ensure that consumers take out mortgages that they can repay. We are not looking to prevent consumers from buying their homes, but we are trying to prevent consumers from taking out mortgages that are unaffordable. One thing that characterised the boom years was the growth in lending made without checking borrowers' income. In 2007, nearly 50% of all mortgages were advanced without the lender checking proof of income. And to the layperson, this seems pretty strange, that you're prepared to lend so much income but have no certainty about whether that person can repay it. So we are putting affordability and checks on whether the borrower can actually repay the loan at the heart of our reform. The proposal that income needs to be checked in all sales has divided opinion more than any other in the discussion paper, because it would take some firms away from the model that they currently operate. The opposition has mainly been from the larger lenders, who argue that the proposal may block access for some consumers, such as the self-employed, and will increase their administrative costs. They add that some mortgages, particularly remortgages, should be considered low risk and therefore not require income verification and be fast-tracked. Added to this, some say that self-certification products are already no longer being sold, and so to an extent the market has corrected itself. We have had many constructive and thoughtful responses to the discussion paper, and it's clear that most people want to work with us and have an intelligent debate about the future of this market. Support for our income verification proposal is particularly strong from amongst consumer bodies, but also from smaller lenders, intermediaries and some trade associations. Indeed, those that support the proposal argue, like us, that everyone should be able to prove their income and that this should not block access to the market for those that can afford to borrow. We recognise the assessment of affordability for a self-employed customer is more complex than for an employed person, but we are unconvinced that this is sufficient reason to argue that they should therefore be allowed to continue to self-certify. And the international experience has shown us the benefits of income verification and a more robust approach to assessing affordability. We have seen many countries like us where there have been high levels of growth, high house price inflation and borrowing, and all have had some element of a subprime market with similar business models to those that we've seen here. Countries with tighter regulatory standards, where it is rare to sell a mortgage without verifying income, countries like Canada and New Zealand, for example, have fared much better through the financial crisis. When assessing affordability, there is a clear benefit in having a consistent approach to all secure credit. And we took a view in the discussion paper that it may be helpful to transfer to us responsibility for the second charge market and secured loans. In subsequent consultation and feedback, the previous government had also said that this was their policy preference. Now, obviously, the change of government and yesterday's announcement may have some impact on that, although the principle remains the same, that it's sensible to regulate these things in the same area, wherever that may be. And it makes sense for us now to be thinking about our regulatory approach. There's, of course, plenty of work to go through, and one aspect of this is considering what from the existing consumer credit legislation we could mirror in an FSA regime, and how we would want to tailor our approach. Our thinking here is at a very early stage, and we will be consulting with the industry and consumer bodies on the way forward. I should now touch on other proposed extensions to our scope. The government consultation envisaged regulatory change to ensure that consumers didn't lose out when their regulated mortgage was sold to an unauthorised firm. Our particular concern is the sale of distressed mortgage books to unregulated firms such as hedge funds. There was a strong agreement with this proposal, but respondents to the government consultation identified potentially significant unintended consequences for the funding markets. Further work needs to be carried out at the Treasury to resolve these issues, and we're told to expect revised proposals later in the year. The final area of scope extension was the regulation of the buy-to-let market. We made plain in the discussion paper that we saw a case for regulation based both on the issues within the market itself and the potential for the buy-to-let market to be used to get around changes that we were trying to introduce to the rest of the market. The previous government said it was convinced that it was right to regulate buy-to-let to better protect consumers from harmful practices. Again, we're waiting to see the new government's view on this and whether it will be taken forward. Another area of the discussion paper where we suggested that we may have to do more was financial standards for what we call non-banks. These are specialist lenders that entered the market during the boom years and relied on wholesale funding to lend to niche sectors of the market. We also looked at whether we should limit where they could get their funding from and look more carefully at their business models. We've been undertaking careful statistical analysis to inform our thinking in this area, and we are producing a picture of past lending based on more than 4.5 million transactions from 33 firms. This analysis of product features and types of consumers will tell us a great deal about the relationship between particular products that are sold and the levels of arrears and possessions that result from them. And this is going to give us an important contribution to our thinking more generally about the wider economic impact of past unsustainable lending. In the feedback to the discussion paper, we got pretty robust reaction to our proposals on non-banks. The main thing people are concerned with is that an ill thought out and disproportionate response would see us lose what most agree is a useful and necessary part of the market. Just to be clear, this is not what we want to do. We do not want to reduce choice, responsible innovation, or jeopardise the market's recovery, but we must recognise that there's been some lending in the past where short-termism, either by the lender to make a sale or the borrower in order to purchase their home or free up equity, has overridden what would have been best for both in the long term and has been unsustainable. There is a consensus that some action is needed, and while the banks and building societies have told us that they mainly favour an increased prudential regulation of non-banks to bring requirements in line with theirs, others favour closer supervision of non-banks' business models. Moving on to look at the products themselves, I spoke earlier about our change in the approach to looking at intervening in products and business strategies at an earlier stage. However, there is a general agreement that for the mortgage market, in order to protect consumers, there aren't really grounds to ban the sales of loans above a certain loan to value or a loan to income or a debt to income threshold, as some have suggested. People tell us that such measures would be too blunt and they would not take enough account of individual circumstances. This fits with our own analysis, but we see the value of looking at these factors when considering the overall risks of a particular lender or at a macro-potential level across the market. A better approach could be to deal with loans that combine some combination of high-risk characteristics to form a toxic mix. For example, a loan that combines high loan-to-value, interest only and subprime might be something that leads us to greater cause for concern. We're now analysing the data to see if there's any merit in taking action here, and we are looking for evidence to show us whether there are types of loans that are more likely to end up in arrears. This looking at the design of products and the marketing of products to vulnerable consumers reflects our new conduct strategy. We want to ensure that the risks to consumers are considered at the outset and not after the event, as has sometimes been the case in the past. So, looking ahead, later this year we will issue another consultation paper on distribution, covering selling standards, intermediary affordability, assessments and professionalism. In all, this will lead us to put forward over the course of the year a package of proposals and rule changes that will represent fundamental change in the mortgage market. We don't believe that this is a crackdown on the mortgage market or a knee-jerk response to the financial crisis, but we think this package will lead to the rebuilding and strengthening of our market for the long term. We don't want to be back in 5, 10 or 15 years under whatever organisation talking about the same things because we didn't take the opportunity now. In looking at these changes, we have to recognise that we have a market that isn't currently working as well as it should. There's going to need to be a change by everyone, the regulator, lenders, brokers and consumers, working together to put things right. In due course, we hope to again have a stable and growing market, with the changes we are making now ensuring that the growing market is sustainable and working well for everybody. So I hope that today this has given you a flavour of the context for our work on the mortgage market review and an idea of what the reaction has been so far and where we plan to go. Thank you very much.
Jonathan, thank you very much indeed for that.